Target, the retail giant with the iconic bullseye, is making corporate headlines for all the wrong reasons. Faced with 4 years of sluggish sales and intense competitive pressure, the Minneapolis-based company just announced its deepest corporate cuts in a decade. This isn't just trimming the fat, it's a major structural overhaul signaling high stakes for the future of one of America's favorite big box stores. The restructuring confirms the elimination of 1,800 corporate jobs. This figure is composed of two groups: 1,000 employees receiving immediate layoff notices and 800 open positions that will remain unfilled. Crucially, these cuts apply only to headquarters staff, leaving store and supply chain roles unaffected. Target heavily targeted leadership roles, reducing executive headcount at 3 times the rate of individual contributors. Incoming CEO Michael Fidelke, who takes the helm on February 1st, was clear about the painful necessity of the decision. In a memo to staff, he stated the goal is simple: to make Target faster and more efficient. He diagnosed the company's core problem as organizational bloat, writing that the complexity we've created over time has been holding us back. This corporate shakeup stems directly from financial struggle. Target has endured 11 consecutive quarters of weak or declining comparable sales. Since hitting its peak in 2021, the company's share price has plummeted by a staggering 65%, highlighting investor anxiety. Inflation-wary customers are pulling back spending on discretionary items like apparel, which are core to Target's business model. Adding to the pressure, Target's disappointing results stand in stark contrast to its largest low-price rival, Walmart. Walmart benefits significantly from groceries, which account for roughly 60% of its U.S. sales, a recession-proof category. Target, with less than a quarter of its sales coming from food, is far more exposed to the whims of consumer confidence. In an attempt to lure back shoppers, Target has reduced prices on over 10,000 items and introduced the new Target Circle 360 paid membership for unlimited same-day delivery. For investors, reducing corporate overhead should improve margins, but the consensus rating remains a cautious hold. Wall Street is waiting to see if these job cuts translate into measurable improvements like stabilized comparable sales growth and faster decision-making. The execution of this dramatic shift lands squarely on the shoulders of the incoming CEO. Target has exchanged corporate headcount for promised speed. The question now is whether streamlining the top layers of the organization is the necessary catalyst to restore growth, or if these cuts are merely a bandage on deeper retail sector wounds.